Good evening, everyone. I'm Paul Moore with Wellings Capital, and I'm so excited to be here with you this evening. There's a lot of you coming on still, so I'm going to wait about 30 more seconds to get started. But thank you so much for joining us. We are really glad to have you here on tax day. I think while I'm waiting, I'm going to actually do a little tap dance here to entertain you while other people are coming on. Wait a minute, you can only see my face. So you can just imagine that I'm tap dancing, and we'll be getting rolling here in about 20 more seconds while people are still joining. Thanks for joining us on tax day, April 15th, 2019. So we're really glad you're here. You know, it's weird doing podcasts because you can't hear the laughter or the boos. So I'm just assuming you guys are smiling as I made my tap dance joke. I should do some tax jokes, but they're not always really funny on April 15th. So I'm going to leave that alone. I'll leave that to the comedians. Anyway, hey, so the question for tonight is, are you still paying taxes? And that's a little tongue in cheek, but I will tell you that I know a lot of commercial real estate investors, and a lot of commercial real estate investors truly are smiling today because today is a day when they are not paying the taxes that they used to when they worked a W-2 job or when they didn't have their taxes in order. So tonight we're going to talk about approximately a dozen different ways for you to save on taxes if you're a commercial real estate investor. So I just want to make it clear for you who are around in the 70s, you'll know what this means. I'm not a CPA and I don't play one on TV. Okay, so seriously, I'm not a tax advisor. Tonight's goal is not going to be to take a deep dive into these topics. I'm going to skim the surface of about a dozen different topics and then 6 more bonus topics at the end, and we're going to talk very briefly just to whet your appetite on why we love commercial real estate investing. I do have a special guest on. I'll introduce her later. I'll tell you it's Diane Gardner, and she is listening in to catch me in my mistakes or to jump in and answer any questions you have. So we're going to have a big time for question and answer at the end. So what I want you to do is there is a questions panel on your GoToWebinar on the right side there on my screen. You can add in any questions in that questions panel, and we will try to answer as many as we can at the end. So I'm going to try to go about 30 minutes, and then we'll open it up for questions and hopefully some answers. So again, I'm Paul Moore. I'm not a tax professional. I am an entrepreneur, author, real estate developer, and investor, and I have a long history in real estate since the year 2000. I was finalist for Michigan's Ernst & Young Entrepreneur of the Year a couple times. I've built multifamily, I've operated multifamily, I've been a syndicator, and now we have 2 commercial real estate funds. We have the Wellings Growth Fund 1 and the Wellings Income Fund 1. I'm the co-host of the podcast, How to Lose Money, and that's where I met Diane Gardner, our special guest this evening. And so we're really excited to go this evening. So we're going to talk about 10 tax strategies for commercial real estate investors. And so these are some of the reasons that commercial real estate investors are smiling today while a lot of people are frowning. So hopefully you're smiling, or hopefully you will be smiling next year this time. So my first strategy is hire a tax strategist. I want to tell you about Ed. Now, Ed is a friend of mine from California, and I got to know him because I Googled back in 2012 or so. We were building a Hyatt hotel, and I Googled finding a tax strategist. I didn't know if there was such a thing as a tax strategist, but I Googled that because I wasn't sure if we were setting up our land and our building and everything as well as we could. And I found this story by Ed, and Ed said that he was paying $120,000 a year in taxes as a commercial real estate investor, and he thought that was normal. And then he found some tax strategies that he wasn't using, and he met his CPA for lunch, and he said, hey, what about this? And what about that? And these are some of the strategies we're going to go over tonight, by the way. And his CPA said, yep, that's right. That's right. Yeah, that's good. That's good. Yeah. He said, well, why aren't we doing this? And the CPA said, wait, you pay me to do your taxes not give you tax strategy? Well, of course, Ed fired the CPA real quick and he got a new one. And Ed said in the decade or so since he got a tax strategist rather than just an accountant or CPA, he's paid exactly zero in income taxes, all legally, all ethically, all above board. So an accountant is somebody, at least in this case, who a CPA or accountant is somebody who does your taxes. A tax strategist is someone who helps you arrange your affairs to make sure you minimize taxes. So I wrote an article on Bigger Pockets and did a video. Should you fire your CPA? Well, if you like your CPA and they're doing a good job for you and they're doing your taxes, you don't necessarily need to fire them, but you want to make sure they're a tax strategist, or you want to hire a tax strategist to help you set things up and then use your CPA or that accountant to do your taxes. You don't have to fire them, but hey, many of you probably will. So who do you contact for this? Well, contact Wellings Capital, because we have a couple recommendations on tax strategists who've done a great job for us and some of our clients. One of them is on with us this evening, Diane Gardner. So tax strategy number 2, invest directly in real estate. Now you can invest in a company who owns real estate, or a fund who owns real estate. Sometimes those are REITs, sometimes not. And you can actually invest directly in real estate. We're recommending a strategy where you invest directly in real estate. How will you know if you're invested directly? Well, you're going to be getting a K1 rather than a 1099. If you get a K1, you're directly investing. That means you're going to be able to take advantage of all the depreciation, the deductions, the amazing tax benefits that commercial real estate investors enjoy. Now, folks, there's a reason that most of the Forbes 400 invests in commercial real estate, and they invest directly. And we recommend that you do the same thing. Tax strategy number 3, accelerate depreciation through cost segregation. Now, you may know this, but when you buy real estate, you've got land, which is not depreciable, and you've got buildings that are depreciable. Now, residential real estates generally depreciate over 27 and a half years. Other commercial real estate's often done over 39 years. And a lot of people think you can just do straight line depreciation, which means you're doing an equal amount of depreciation every year over that period. But that's not necessarily true, because there's also real versus personal property. Real property is like the building, the structure, the walls, the foundation. But there's also personal property. So for example, with an apartment building, you've got carpet, you've got cabinets, you've got lighting, you've got parking lot stripes, you've got shrubbery, you've got, that's a little joke for you Monty Python fans, you've got all these different things that can be depreciated over a shorter time period. And so why not do that? Anybody who has looked at those, those studies of what a dollar doubled every day and taxed along the way versus not taxed along the way, it's a massive, massive difference in outcome. And so if you can save taxes in the early years, you should, and accelerated depreciation is the way to do that. You can bucket things into like a 5-year life, a 7-year life, a 15-year life, rather than have it all depreciated over the longer time period. There's 2 types of cost segregation studies. We won't get into this. There's a basic study, which might be a few $1,000s. There's also an engineering study, which involves engineering, CPAs. It's much more detailed, and those can cost over $10,000. How much can you save? Well, you can often write off or accelerate 20 to 30% of the depreciation in a building, take it off of the straight line and put it into these shorter buckets. And by doing that, again, you can depreciate that sooner, and you can often end up in a situation like most of our investors end up in, where they're getting a cash distribution, but they're actually getting a negative number on their K1, or they're actually saving on taxes almost every year. So we talked about the cost of the study. Who qualifies? If you've got a building, if you want to do a simple basic study and you have a building of $100,000 or more, that could be a duplex, for example, you might be able to get away with a basic study and you might be able to save money. If you have a building of, let's say, $500,000 or more, like a self-storage facility or a larger apartment building or a larger commercial building, you're going to possibly want to do an engineered study, which is more detailed. It potentially could find more savings. It's more defendable before the IRS, and you will be able to, potentially save more money with an engineering study. And again, like I said, if you have a building that's about $500,000 or more. Tax strategy number 4 is to make sure you're correctly deducting or classifying deductible expenses. If you have expenses that you're depreciating, capital items that you're depreciating over many years, you might find out that some of these are actually repairs and could be deducted in the same year. So capital improvement items are items where you're improving the property. For example, we just put a dog park at an apartment complex Wellings Capital owns. Well, that dog park is going to be, I think it's going to be a 15 you can deduct up to $15,000 in the current year. Now, somebody told me that my audio cut out, and so I want to know, can you hear me? I can definitely hear myself, and so Ben, let me know, can you hear me? Not sure what to do here. So my sound is working fine on my end. So Ben, can you chime in here and tell me what's going on? Okay, Ben says I'm good. So sorry about that, folks. So section 179 is where you can deduct. Like, let's say you buy a computer. That computer's life, let's say it's got a 5-year life, and you can, instead of capitalizing it and deducting a portion of it over 5 years, you can deduct it all in the same year under section 179. So that was my example. Let's talk about tax strategy number 5. And this may seem self-evident, but it isn't always. It's called return of principal. Now, if I'm paying you, if our fund is paying you money every year where you're getting these distributions, part of that could be income, and part of that could be, deducted over, part of that could be deducted as income on your taxes, but also part of it could be return of principal. So for an example, we have a 9% preferred return on our funds. And if you get the 9%, let's just say that's our distribution for the year, that will all be considered income. And by the way, like I mentioned earlier, these deductions, these accelerated depreciation items can often offset 7, 8, 9% of the income per year. Anything above 9% preferred return in our fund is actually considered return of principal. So if we have an 11% distribution in our income fund, that will be return of principal above the 9. And so that's not taxable. And we do it that way to get some non-taxable cash back in your hands and allow you to reinvest. The impact on taxes is obviously 0 because you're not paying taxes when you get a return of principal. And so if we're going to get into another example about this soon, but like I said, anything above the pref in our fund is considered a return of principal. So tax strategy number 6 is related to that. It's called refinance, tax-free, and reinvest. This is one of my favorite strategies. Now think about it. If you're refinancing your home, let's say you go to the bank and you've got a $100,000 mortgage on your $200,000 home, and you get a $60,000 home equity line. That $60,000 in proceeds is obviously not taxable. Well, it's the same here. Now, example of this is in our income fund, Wellings Income Fund 1, our goal, our target is to return the principal to investors in years 4, 5, and 6. And so we're hoping to return most or potentially even all of the principal to investors in years 4, 5, and 6. And so if we return that money to you, obviously it's tax-free because it's a return of principal, but it also means something else that's really powerful. Think about it. You can reinvest that money and you can have two streams of income going from your initial investment. So if you invest $100,000 and you get that $100,000 back halfway through the investment, but your investment in our fund continues to grow and throw off income, that's great. But now you have the $100,000 back in your hands. And so you can invest that with another fund that Wellings Capital has, or another fund entirely, or something else entirely. And now you have two trees growing from one seed. It's very powerful. And if you think about this, if you do this over several cycles, let's say, so you've got our fund that's growing for 10 years and a new one that starts in year 5, but in year 10 you're doing it all over again, and you've essentially got 4 trees growing, and then there's 8 trees growing, etc. And so you're creating multiple income streams with your one initial investment. And this is why we love our Wellings Income Fund, and a lot of other people love that tax strategy, that tax saving strategy as well. Tax strategy number 7 is something most of you are probably familiar with. It's called the tax deferred exchange, also known as a 1031 like kind exchange. Basically, if in the past when people came up with this, basically, let's say someone was selling their 100-acre farm and they wanted to buy a 300-acre farm. Well, if they had to pay capital gains on that farm, they were going to have a huge chunk taken out of it. So Congress passed a law that allowed them to essentially exchange the 100 acres for the 300 acres. They're exchanging up, and they don't have to pay capital gains. Now, if you're exchanging out of real estate into another piece of commercial or or rentable real estate, income producing real estate, you are allowed to do that type of exchange. And so that's how it works. And there's actually a little loophole, from what I understand, in the 1031 exchange rule, and I've had at least 2 clients use this. Here's what they did. I had a client last year who sold several pieces of rental property, and he bought a lakefront rental property at Smith Mountain Lake in Virginia. So he sold a bunch of duplexes. He bought I think it was a $600,000 home at Smith Mountain Lake, and he is putting that on the rental program for a couple of years. After 2 years, again, from my understanding, he is able to basically convert that to a primary residence. And by doing that, he can now move in, and he never has to pay the capital gains tax that he would have accrued over all those years where he was growing the value of those duplexes and the other rental properties. So the point is, he put the rental property, he did rent it out, and his intention was to rent it out, but at some point he has the opportunity after 2 years or more to convert that to a private residence. We're going to talk more about the 721 exchange a little later, but a 721 exchange is a way to also avoid it's another way similar to a 1031 exchange, but it's exchanging shares in one company for shares in another company. And of course, all these pieces of real estate are in LLCs, and so that is something that we are planning to employ at Wellings Capital in our income fund. Tax strategy number 8 is to avoid passive loss limitations by becoming a qualified real estate professional. Now, what that means is this: you are limited. I'm going to look at my notes here. You are limited to about $3,000 in passive losses if you are not directly and actively involved as a real estate professional, or if you're involved as a passive investor, which we believe in doing that. We think that most people would be happiest being a passive investor. But if you are in a place where you are doing more and more real estate and less of your other job, you can become a qualified real estate professional. And there are about 5 rules that you have to, 5 boxes you have to check to become a QREP. But in summary, you have to, a couple of the big ones are, you have to spend at least half of your time in real estate investing. And number 2, you have to work at least 750 hours per year in real estate investing. So that's how you qualify. And like I said, there are several other boxes to check, but those are the main two. If you haven't done this, you may want to consider it. I've got one of our prospective investors as an oral surgeon in the Pacific Northwest, and he said he is going to sell half of his practice. He's going to bring in a partner, in other words, and he's going to gear down his practice to where he's only practicing, let's say, 1,000 hours a year instead of 2,000 hours a year. And then he's going to spend 1,000 hours or more per year in his real estate investment business, and that will allow him to qualify. Now, what this means is you're not limited to $3,000 in losses per year. You're allowing yourself to possibly write off unlimited losses. And like I said before, our accelerated depreciation and other things that commercial real estate allow us to do allow you to potentially be putting a check in your bank account every month or every quarter, but actually having a loss on your K1. So this is very, very important for some people to be able to do that. This doesn't apply to everybody. There are certain income limits. And again, our goal this evening is not to go deep, but just to skim the surface and whet your appetite for more. Now, you all know about this one, tax strategy number 9. You want to consider the possibility of using a self-directed IRA or 401k. Did you know that about 97%, from what I've read, of IRA and 401k money are in traditional investments like the stock market, mutual funds, bonds, and that might be an okay thing. But there are a lot of people who should consider self-direction. And so I've had a self-directed IRA and a self-directed Roth IRA for many years. Now this year, I heard about a self-directed 401k. Now self-directed IRAs and Roth IRAs generally have contribution limits of $6,000 a year, but the self-directed 401k, now it's tied to your income, but self-directed 401k has a limit of $55,000 per year. And if you're over a certain age, you can actually go $61,000 a year. So self-directed 401k, self-directed IRA, self-directed Roth 401k or IRA are great options. And we've got some great providers that Wellings Capital works with, and we can recommend them to you. Who shouldn't do this? If you're given to extremes, if you're given to chasing shiny objects, if you're the kind of person who honestly confuses gambling versus investing, you may want to not do this. You may want to stick with a nice index fund and just keep your money in the market, or you may want to be getting somebody who can really, really help you invest. Because I know a lot of people who, once they got control of their own IRA or 401k, they made a lot of mistakes. They threw all the money into the next big thing, like an oil well or whatever. On my podcast today, I interviewed a great commercial real estate broker from Arizona, and he had refinanced his expensive house, and he put $3 million into an oil and gas deal in Kentucky, and he lost $2 million of the $3 million. Yeah, he got a write-off, but Diane's on here and she would tell you it's not the same. I mean, you lose that much money and it's painful. And so consider the possibility of not doing this if you're the kind of person who you wouldn't trust to invest that money. But I think you're all the kind of people who could be trusted. So think about a Roth, think about a SEP IRA or self-directed 401k. I'd say about 20% or more of the Wellings Capital investors who are investing in our funds right now are using IRAs or self-directed 401ks. Now, my mama told me that there's 2 things in life you can't avoid, and that's death and taxes. Well, I think you can avoid at least one of those. Now, one thing you can do, though, is you can avoid taxes at the time of your death. Because here's just a quick example. If you know you're in your last days of your life and you say, oh, I've got all this money tied up in all these real estate investments, my kids probably would rather have me sell them, and you go sell everything, pay the capital gains tax, and then you pass away, you're going to leave your kids with a much, much lower amount of money in many cases than if you would have just held on. Now, if you pass away and these assets are in your estate, you are able to exempt a lot of the, you are able to exempt and reset that capital, the basis in those properties back to the current market value in many cases. There are limits to this. Now, great news, we recently saw those limits go up from $11 million for a couple to $22 million. And for an individual from, I believe it was $5.5 million up to $11 million. So you can reset your basis, which means, let's say you've got $10 million in real estate, you pass away, let's say $8 million of it would have been capital gains, subject to capital gains. If you do it this way, you can reset that basis and your heirs can say, okay, no, it's $10 million is our basis in this. That's what we inherited. And now if they sell it the next day or the next month for 10 million, they have zero capital gains. It's very powerful and it's something we all want to consider. So the Tax Reform Act, love him or hate him, you got to know that our commercial real estate investor in the White House really helped commercial real estate investors across the fruited plains. So we're going to talk very briefly about 3 bonuses that we got in December of 2017 when the new tax law was passed. First of all, you've probably all heard about the 20% pass-through deduction. And it was thought for a while that, what, do I have to have this in an LLC or do I have to have this in a certain structure to get this? No, pretty much anybody who is actively involved in investing in real estate can claim this 20% deduction. So just a quick example, if you would have had $100,000 in income taxes due to your real estate investing activities, this could potentially slash it from $100,000 down to $80,000. Tax reform bonus number 2 is bonus depreciation. Now, Section 179 of the IRS code, I mentioned it earlier, says that you can write off a certain number of things that would have been depreciated all in the same year. And there's a $1 million limitation now. It's been raised to $1 million. So if you have a whole bunch of roofs at your apartment complex and you replace all those roofs, and if it qualifies for bonus depreciation, instead of writing those roofs off or depreciating those over 15 years, you can depreciate them all up to $1 million in the same year. So really powerful. I love this Section 179 change in the law. Now, this goes out or it phases out starting in 2026. So if this is something you want to take advantage of, do it in the next 7 years. The third bonus from tax reform, I don't know if you all remember, but real estate investors were very, very nervous in the fall of 2017 when Congress was debating this new tax reform. We thought we were going to lose our beloved 1031 exchange, but it turns out that the 1031 exchange was eliminated. If you're an art dealer, or if you have a car or truck or plane, it was eliminated, but it was maintained for real estate investors only. So another reason real estate investors are smiling on tax day. Now, a lot of investors come to us and they say, hey, I could save a lot of money through this 1031 exchange, but it's cumbersome. I've got to name these assets within 45 days. I've got to close in 4.5 months after that, 6 months total. There's just a lot of hassle. I've got to get a qualified intermediary. I got to make sure all the paperwork's right. A lot of people don't want to do a 1031 exchange. And in this day and age, a lot of people can't find a deal they want to buy. Multifamily is widely overheated. A lot of other real estate's overheated as well. If you want to avoid 1031 exchanges, there might be 3 different ways you can do that. Let's talk about those. So 1031 avoidance strategy number 1 will be invest in an opportunity zone. Now, the federal government asked the states to name some, let's say, urban blight type areas or previously urban blight, improving, gentrifying areas that they wanted to designate as opportunity zones. So every state did that. And now if you invest in one of these opportunity zones and you meet all the criteria, you can potentially get a waiver of your capital gains tax. There are all kinds of limitations on this, and there are all kinds of reasons that you may look into it and decide you don't want to do it. One of our wonderful investors, Troy, who's probably on here, I know he's really excited about investing in opportunity zones, but there are limitations. For example, if you pull the money out in 5 years, you only get, I believe it's 10% of your capital gains written off. If it's 7 years, you only get a 15% write-off of your capital gains tax. But if you go 10 years, just 3 more years, you get 100% write-off. There are limitations. You have to keep at least 80% of the money invested in opportunity zones at all times, and they check regularly. There are other limitations that could cause you to pause before you do this. I mean, think about it. You are investing in an area that had previously been kind of in a downtrodden, might be a downtrodden part of town. So please don't let the tax tail wag the dog. Make sure it's a good investment first, and make sure you're investing with a great operator. So opportunity zones is one way to avoid the 1031 exchange. A second way is a 721 tax deferred exchange. I'm going to kind of hurry through this. We're getting to the end of our time. The 721 exchange is somewhat similar to 1031 exchange, but instead of exchanging real estate for like-kind real estate, you're basically swapping stocks for another type of stocks. Here's a quick example from outside the real estate world that'll make it make sense. Let's say you build up a tech company or some kind of company from $0 to $100 million, and you were selling it to Berkshire Hathaway. Warren Buffett was coming in to buy it, and you said, gosh, I'm gonna have to pay capital gains on $100 million. What if I swapped my shares of my company for Berkshire Hathaway stock? If you did that, that would be potentially a 721 exchange, and you could potentially avoid the capital gains on that. Wellings Capital is planning, though there's no guarantees, we hope and plan to use a 721 tax deferred exchange at the end of our 10-year life from our Wellings Income Fund 1 if there are certain assets that we want to continue to invest in. Now, every investor at that point would have the opportunity to cash out and move on, or they might be able to hold on through a 721 exchange. Now, there's a third 1031 avoidance strategy, and it's called an installment sale. And you're going to laugh, maybe, but I don't understand installment sales real well. So that's why we brought Diane Gardner on the call with us. Diane is a certified she's an enrolled agent in all 50 states of the US, which means she can practice tax law. She can do tax returns. She is a great tax strategist, one of 2 great tax strategists we have. The other one's Warren Tarl. Some of you know him. But Diane's with us tonight, and I can't believe that she took the evening of April 15th off of work when she's filling out all these tax returns this evening to spend with us. So she's going to join us now, and she's going to tell us what is an installment sale and how can you potentially take advantage of it. Diane, are you here?
I'm here, Paul. Can you hear me okay?
Yes, I can.
All right. Well, the best part about this type of a 1031 avoidance strategy is we get to take the wonderful tax avoidance of an installment sale, but turn it into a couple, or I'm going to say couple it with a loan, so that you're going to get all your money basically up front and not have to wait year after year after year after year as those loan payments are paid to you like you would in a traditional installment sale. So this particular strategy allows us to basically use it on properties that are valued at $500,000 or more, that have a fairly good size amount of capital gain in them. It uses a third-party dealer in capital assets to defer receiving the sale proceeds. So they take the sale proceeds and then they loan you the money back for 30 years. It's based on a tax code dating clear back to 1913, and it was supported by a 2012 recent IRS memorandum, which gives us a nice, warm, cozy feeling that this is a pretty good tax strategy. We know that you'd like to have the proceeds from your sale now and not have to wait 30 years out to get those final proceeds because you've set up an installment agreement. So with this strategy, this third-party financial institution lends you back your proceeds, and they'll lend you up to 95% of the sales price. So that basically puts your money back in your pocket, and then you're able to take that money, go ahead and invest in whatever your next property is, or multiple properties, depending on what you've got going. And then at the end of the installment period, 30 years down the road, the dealer will pay you that agreed selling price, you'll repay the loan, and it's over and done with. So this has been a wonderful strategy, one that I've used with a few of my clients, and it has put a nice chunks of money back in their pocket in a very nice legal way that's been blessed by the IRS.
So Diane, I understand from some of my California investors and other states that there's an additional capital gains tax added on to the federal tax. Is that true?
There is potentially an additional capital gains tax at the federal level, and depending on what state you live in, possibly even a state tax. So we can defer both of those taxes out for 30 years.
Wow, so this works for the federal and state capital gains tax in some instances.
It works as long as the property qualifies. It would work in any state.
Wow. Well, I'm sure we're going to get some questions about that. So we're going to go to question and answers now. Before we do, I just want to say again that I'm not a tax professional, but Diane is. And so anything that I said on this webinar, maybe Diane can clarify it for you if you want to go a little deeper. I doubt that we'll get through all of your questions tonight. So put them in the questions panel, and I'm going to give you Diane and my contact information. So if you want to reach out to Diane, you can do that at her website, or you can do that at her phone here. Her phone number is 208-687-0508, and her website is taxcoach4u.com. That's taxcoach4u.com. And I'll give you my contact information in a little bit. So we're going to go to questions here. I'm going to get a drink of water, and I'm probably going to defer a lot of these questions over to Diane. So, hey, Jeff. Okay.
So, Paul, I see a question that says, what happens at the end of 30 years with the installment sale? At that point in time, the loan is paid off, the tax is paid, because we usually have you set up take a certain amount of your proceeds and invest it in some sort of a fund, so you've got the money to pay the tax at the end of 30 years, or it's sitting there for your heirs or something along those lines. And then the tax is paid at the end of 30 years. It does require an extra form on your tax return, but that's no big deal. And you're able to put a bunch of money back in your pocket that you potentially wouldn't have otherwise.
Okay, great. Diane, feel free to go ahead and field any of these questions. I'm looking mostly through people who noticed that my sound cut out.
Some recapture of depreciation. One of the nice things under the new tax law is the bonus depreciation has we call it a less harmful recapture than Section 179 does. So as a tax professional and a strategist, I'm always looking to see what would happen if they sold that asset earlier. And can we take advantage of one strategy versus another and insulate them from having to recapture as much of that depreciation down the road, or recapture it at a better rate than another strategy might give them?
Okay,
I'm not sure
great.
if that answers your question or not.
All right, well, keep your questions coming, folks. Someone asked, is Wellings Capital planning to offer opportunity zone investments? We are looking at that. We are very, very slow to partner with anyone. We take a long time vetting people, vetting deals, and we are looking at different opportunities. We've actually referred a handful of investors to an opportunity zone deal that we like, and though we can't vouch for it because we're not investing in it ourselves, we can tell you that we really like the operator. We really like what we see of the deal, but we are being really, really clear. You need to vet any of these on your own. If you're going to get involved in that, you have to check it out on your own. Someone asked, can we get the slides and the recording? Yes, you will automatically get the recording of this, and the slides will be part of that recording. Someone said, are there any dealers that offer the installment plan with less than 500,000 lower limit? Diane, can you talk about that? And can you
Yeah,
talk a little more about the one that you know, because I think that's pretty intriguing.
right. And I'm going to chime in and say that I'm not aware of any that will do it on properties less than 500,000, just because there are costs involved in it, and there's a lot of paperwork that needs to be filed. And so they want it to be worth their while to carry that loan out there for 30 years and be able to pay you your money up front. So as far as I know, properties need to be over 500,000.
And I don't mean to be picky here, but I mean, what if it's 490? I mean, will they literally not talk to you then?
No, they will. We've run it on about 450, but we have to have a certain amount of capital gain in there to make the numbers work. But we're always happy to run a set of numbers, and we'll be really quick to tell you, yes, this property looks like it could qualify, or no, it's not going to qualify.
Okay, great. Diane, you might have already answered it because I was looking at questions while you were talking, to be real honest with you. But what happens at the end of the 30 years with the installment sale? Did you already touch on that?
Yes, I did.
Okay.
Yes. There's a question down right below. It says, what type of professionals perform cost segregation? Anytime you're working with a tax strategist, they usually are working with at least one, if not two, companies who provide cost segregation studies. And they'll help you get hooked up with a company who will fit your needs and the size of property that you have.
Okay, great. So Diane, can you tell us when a cost segregation study might not be helpful? And I don't mean just based on the dollars. Let's say it's $1 million property. What type of $1 million property might not be a great fit?
One that doesn't have a lot of pieces to it. And pieces, I'm going to talk about electrical, plumbing, roofing, landscaping, parking lot, a lot of those kinds of things. If it doesn't have those, it makes it pretty hard to change the outcome from a cost segregation study.
Okay. I can tell you folks that our Wellings income fund is actually investing in mobile home parks. And I would have thought mobile home parks would be not great for depreciation, but I was really surprised to find out that a typical, not all, but some mobile home parks are only really 30% or so land. 35% land improvements like lighting, parking lots, shrubbery, all those type of things. And those can be along with goodwill, which is another 35%. So that's 35 and 35. That's 70% of the asset, which can be potentially written off over 15-year straight line. And you might say, oh, that's not so great. It's not as good as 5 or 7. But if you do the math, you're going to have to really hang with me here to get this. So if you do 70% of your asset, again, that's everything but the land, over 15-year straight line, that means 4.66% of the asset value can be written off every year. So you might say, oh, not bad. That's 4.66% of the income I'm covering with depreciation. In other words, I'm breaking even if I'm getting a 4.66% distribution. That's not necessarily true, because with leverage, you're leveraging that amount. So let's say you do a 60% loan to value ratio. If it's a 60% loan, you're effectively dividing by the 4.66% divided by 1 minus 0.6, 60%, or 0.4 in other words. And so you're effectively multiplying that 4.66 by a 2.5x leverage. Okay, so now you're covering 11.66% of your income in that example. Okay, that means if you're getting 11.6% distribution that year, you're fully covered and you're not getting a profit on your K1. Pretty good deal. And now with the 721 exchange, one of the benefits of that is if we take that mobile home park 10 years and then we do a 721 exchange, you investors in the Wellings Income Fund, let's say some of you want to hang with us, we do the 721 exchange, guess what? We start the depreciation clock over at day 1, meaning you're going to get 10 more years or maybe up to 15 more years of that straight line depreciation. Diane, there's a question that starts out with depreciation is recaptured at sale. Can you take that one?
Depreciation is recaptured at sale unless you've used straight line depreciation. So any of the bonus depreciation, Section 179, any of those types of depreciations, if you're using makers or any of those where you're taking accelerated depreciation, you will have some depreciation recapture at sale. And that will all get reported usually on a Form 4797, where it'll break down the various components, and the depreciation recapture will end up being picked up as additional income on your income tax return.
Okay, so it's the question, in the detailed question here is depreciation is recaptured at sale. If I join a fund that claimed bonus depreciation on one of its assets last year, I would have missed out on that paper loss. When that asset is sold, I would have to pay tax on recapture of the depreciation I was never even part of. Is that correct? That's a tough one.
That is a tough one. I would think that you would have been able to take advantage of the bonus depreciation up front in the year that it was taken, and been able to use.
He didn't invest in the fund till a year later.
Right,
And then
yeah.
they used it in year one, apparently.
Yeah, that is a tough one. Those are the kind of things that sometimes it's better to set up a call with one of us and get into those kind of specifics.
All right, good. So that's a great question, by the way, truly.
Yes.
And I'm sorry if that happened to you. One of the reasons we do our Wellings Income and Growth Fund in the same year is to avoid that kind of stuff. But I'm not 100% sure we can even totally avoid it. That's a great question. Someone said, are there any good ways of using real estate to offset large amounts of earned or W-2 income from a job? Diane?
The best way to make that particular strategy work would be to become a real estate professional. We do have another question that wants more information on what would it take to become a real estate professional. Real estate professionals spend their time consulting with advisors. They're negotiating leases. They're talking with property managers. They're managing or supervising rental activities on a property. They're doing the stuff. And that allows them to have that active participation instead of passive participation, which then allows them to write off the loss that actually happened for that year. Does that, okay. Hopefully I got that one good enough?
Yeah, I think so.
And real quick, this is Ben Colley. I'll jump in. And Diane, you can correct me if I'm wrong, but if the investor, this person invested and they received a K-1, doesn't that directly affect W-2 taxable income? Doesn't affect their tax return?
It could, depending on how big the income amount is. Because if their AGI is over 100,000, they may not be able to claim all that loss unless they can show that they are a real estate professional.
Okay.
Gotcha.
So someone asked, what type of professionals perform cost segregation? Well, you can get hold of us and we will be glad to direct you to a few cost segregation companies that we like. Diane could as well, I'm sure. And these folks charge, like I said, a few $1,000s for a basic study. And I got a quote of, I think, $12,000 on a $9 million asset we owed once for an engineering study. Do you have any quick comments, Diane, on when someone should use a basic versus an engineering study? Let's say it is a $10 million asset.
$10 million asset, I would think that would be the more in-depth study, the fully engineered study. Mm-hmm. I've had clients come to me with small individual homes at like 40 or 50,000 in, and those hardly even pencil out for the smaller study just because they're so small.
Okay.
So it's got to be a little bit bigger than that.
Okay. So what can a non-working spouse, for example, a stay-at-home mom, do to qualify as a real estate professional? What activities count toward the requirement? I would think that 750-hour rule would really come in there. Tell us about that, Diane.
You need to work 750 hours or more than anyone else is working on the property. And you have the ability to do an election where you can group all your properties into one property to help make that rule be met a little bit easier, and you're not having to meet it for each individual property. But it's basically doing the stuff of a real estate professional. You're looking at properties, you're talking with property managers, you're looking into investments, you're talking with whoever is doing your financing. Just a lot of that stuff, but the important thing is keeping a good time record. Keep a calendar of some sort, a diary, something to where you can show that you really did put in those hours, because it makes a huge difference on an income tax return if you're passive or if you're active.
Okay. So a couple follow-up questions to that. That's a great question. One would be if they get a license as a real estate agent and they work as a real estate agent, that does count, correct?
Yes, it does.
Okay. And here's a question, it's kind of out of left field. What if they're just passively investing? What if they're, and I've got a lot of thoughts on why people should consider staying with their day job and investing passively. They might make just as much or more money, get great tax write-offs, and be able to enjoy their life more. But what if they're just a passive investor, but they're really, really involved and they're doing a lot of due diligence, they're flying out to see properties? That could count, right?
It definitely could. Yes, and then it could also qualify them for that 20% deduction that you were talking about earlier, the qualified business income deduction.
Right, under the new tax law.
Yes.
Okay. Does the spouse getting real estate professional status only work if you have negative losses with your real estate?
It works if you are positive or negative, but it helps you be able to deduct the losses that you may not be able to deduct otherwise.
So if you're getting all gains and there's no losses, let's say for some reason the depreciation clock has completely run out on a property you've had a long, long time, the qualified real estate professional might not help that much, right?
Maybe, maybe not. Right.
Okay.
Or think of somebody like myself who's running an accounting practice. There's no way I could ever qualify to be a active real estate professional. I just can't, because I'm running a full-time accounting firm. So right. I'm always going to be stuck in the passive world, unfortunately.
Right. So somebody said, could the capital gains tax be much higher at the end of the 30 years on an installment sale? I'd love a clarification on that question, but I think what they meant is it possible that the capital gains rate could go way up, and could that kibosh your calculations?
Paul, I'm going to say anything is possible. I don't know that it's probable, though I know that capital gains rates have been higher in the past. But I don't know that it's probable, because Congress really wants us to buy properties, invest properties. They don't want vacant buildings that are just running down and creating homes for homeless people to live in and that type of thing. They want us investing in properties and things. So I really kind of doubt that it would ever go up, because there's so much pressure to keep it where it is.
Okay, great.
But my crystal ball isn't working tonight.
Okay, so we're in the last 7 minutes here, so we're going to go into double speed mode. We're going to answer the rest of these kind of like a quick Jeopardy round or whatever it's called. Jacob, I'm going to specifically answer you by name. I will be in Minneapolis next week. You mentioned that you're in that area. Let's get together if you have a chance. Actually, I'll be there later this week. So if anybody here is from Minnesota, Minneapolis area, reach out to me, please, and we'll talk about that. Jacob asked, would a taxpayer need to itemize itemized deductions in order to benefit from the tax benefits that you laid out tonight? Diane, quickly.
No, they wouldn't, because these particular deductions land on a different schedule. Itemized deductions are on a Schedule A. These will typically land either on a Schedule E or a E2, which is where your T1s are recorded.
Okay, great. Can we depreciate a $100,000 car over 2 years?
It depends.
All right. I mean, does it have to be for work to be able to depreciate it?
You would have to, yeah, I would have to know way more about it. It depends. Potentially, but it depends.
Okay. So someone asked, Chris, specifically, I'm going to name you, sorry. Chris, you said, can you give another example? I'm sorry, I might have lost track there. Can you just kind of clarify that question? Someone says, what value of the property would benefit from cost segregation? Diane said like $100,000 and up from a basic study, right, Diane?
That would be the very, very minimum to
Yeah.
be able to even make a basic study pencil out.
All right, great. Someone says, when should you start working with a tax strategist? When is the right time of year to work with a tax strategist? I'm going to answer from my experience as soon as possible. Even though I went to get our Hyatt hotel maximized, we wanted to get our tax strategy down pat for the Hyatt hotel. We found out that the other stuff I was doing, I was paying way, way too much in FICA, which is Social Security, and Medicare, which is 15.3%, that I was flushing down the drain for many years, and I didn't need to. Okay. JD, you can email me that directly. That probably wouldn't be in our bailiwick. Probably wouldn't be something we know much about. Can you still use cost segregation after your accountant started using straight line depreciation? Diane, I know you know the answer to that one.
Yes.
Yeah. You can even do it like almost at the end of the time you own the property and go in arrears, right, for a few years?
You could, but it works much better if you do it more in the earlier years.
Right. Okay. What deductions can I benefit from if I build and rent real estate? Diane?
You can utilize accelerated depreciation, capitalizing various pieces of the building, cost segregation. Any of those types of tax strategies will help.
Okay, great. I'm going to take another quick aside. I mentioned I'd be in Minneapolis. I'm going to be speaking Minneapolis Thursday night this week. If you can come out, that'd be great to see you. I'm going to be in Irvine, California, speaking at a For Investors by Investors event on April 30th. I'll be in Pasadena May 1st at an event. I'll be in LA meeting with investors for a few days. I'm also going to be in the Silicon Valley in San Francisco May 3rd, 4th, and 5th. I'll be in Sacramento and Redding, California around the 6th, 7th, and 8th if anybody wants to get together. So someone says, what depreciation is available in an operating quarry with a $1 billion in reserve value? Boy, that's going to be you, Diane.
That's going to be a separate offline conversation.
Okay. Get hold of Diane. I'll put her email up there, her address. Again, there it's taxcoach4, taxcoach4you.com. Someone says, do things like telephone, gas, business trip, etc. count as deductions?
Yes, they do.
Okay, so a clarification for the other example of the 721, don't really understand the 30-year repayment. I think, Chris, you're asking about the installment sale, the 30-year repayment. Chris, I don't really understand it either. I'm glad Diane's here. Do you want to quickly,
Chris,
Diane, do you have a quick example of a super quick example of a real installment sale you were part of?
Well, one that I did, I had a client who sold a piece of farmland for $1.25 million. Their basis was about $400,000 in it. So at the time that they closed escrow, we were able to put $385,000 back in their pocket. And otherwise, they would have given that between the state and the federal, they would have given that all to the IRS and to their state. And so with that money, they were able to go ahead and invest. We had suggested that they invest about $50,000 of it so that they would have the money to pay the tax at the end of 30 years. And that was a plan we set up with them. And it worked just as smoothly could be. Everybody was happy, and we're a couple years into it at this point.
Wow. So Diane, what if someone's like 80 years old and they want to do an installment sale and they might not be alive at 110 to pay off that? What would you recommend in that case?
Go ahead and do it. It'll pass right down to your heirs. And at the end of 30 years, the money will be sitting out there because you will have set that investment so you'll leave it to them. And then they'll be able to pay the tax at the end of the 30 years.
Does it ever make sense to get life insurance instead of just an investment?
That was part of the investment we were going to be looking at, yes.
So life insurance can be part of it.
Was a piece of it, yes.
Okay, great. So Diane, you, again, the installment sales got some buzz here. You do have people who know how to do this?
Oh, definitely. Reach out to me at my www.taxcoach4you.com, and I'll be happy to have some conversations with you, run some analysis, those types of things for you.
Okay, great. So Diane and I and Benjamin are super honored that you took tax day to smile with us here, April 15, 2019. I hope you're smiling. I'm smiling. And I know it's late, and I know it's 10 o'clock on the East Coast. So thank you so much for hanging in there with us. We really appreciate you, and we will be glad to talk with you. So here's our contact information. You can reach out to us, paul@wellingscapital.com. You can schedule an appointment with us if you want to talk about the Wellings Income or the Wellings Growth Fund. You can invest, or you can actually look at the different documents there at invest.wellingscapital.com. And we will see you again soon. Thank you again for hanging with us this evening. And we will be putting this recording out within the next day or so. And again, we hope to see you next time here at a Wellings Capital webinar. Thanks, Diane. Thanks, Ben. Thanks, everybody. Have a great evening.